Workers are working as productively as ever. Companies keep getting richer. Markets keep trading at record highs. Executives earn more every month. And yet millions of people feel like their paycheck runs out before the month does. Rent, groceries, insurance, and debt keep climbing. An ordinary life now feels like trying to afford a luxury product. If wages are falling behind, the question is simple: where did the money go? The answer is not that the money disappeared. It simply changed hands. Not through a single robbery, not through a secret meeting, not through one law that changed everything overnight. This is the result of a process that unfolded over decades: policy decisions, shifts in bargaining power, asset price inflation, financial engineering, the explosion of executive pay, borrowing, and the concentration of ownership in certain hands. Workers did not stop creating wealth. They simply stopped receiving the same share of the wealth they produced. That was exactly the quiet fracture point underneath the modern economy. From the late 1940s to the early 1970s, especially in the U.S., the promise of development was far more convincing. The country came out of World War II with unmatched industrial strength. Europe and Japan were still rebuilding. American factories dominated global production, unions were strong, manufacturing jobs carried real weight, and public investment kept expanding. The GI Bill gave millions access to education and housing. Highways, suburbs, factories, pensions, and rising wages built the life that still comes to mind today when people say middle class. But that era was no paradise. For Black Americans excluded by discrimination and redlining, for women whose economic options were restricted, and for immigrants struggling with low wages and legal insecurity, that promise often did not hold. Still, the era proved something important. When productivity gains were passed on to wages, an ordinary job could be the foundation of real wealth. A factory worker, mail carrier, teacher, repairman, civil servant, or unionized tradesman could build a stable life, not luxurious, but stable. A house, a car, children, maybe a pension, maybe a vacation, and a future in which retirement didn't require becoming a part-time financial analyst. The reason that world felt different wasn't because earlier generations were somehow more disciplined. They lived in an economy where wages had a stronger claim on growth. When productivity rose, wages tended to rise with it. The system was still capitalist, still unequal, still full of conflict, but labor held more leverage. And that was exactly the point: leverage. Then came the break. The 1970s brought oil shocks, inflation, global competition, and political crises. The 1980s brought deregulation, deindustrialization, weakening unions, tax changes, financialization, and shareholder value, becoming the new religion of the corporate world. Companies learned to think globally. Capital became more mobile. Factories became movable. Supply chains stretched across continents. Workers who once bargained with a local employer now found themselves competing with cheap labor abroad, machines at home, and shareholders everywhere. For most of the post-war period, productivity and average worker pay moved together. But starting in the late 1970s, that relationship broke down. The Economic Policy Institute's Productivity Pay Tracker shows the gap steadily widening since 1979. According to Reuters, in 2026, labor's share of national income in the U.S. fell to a historic low of 53.8%, while productivity had risen by more than 90% since 1980 and wages by only 33%. The numbers tell a clear story. Workers produced far more, but earned far less in return. Productivity didn't stop. What broke down was the sharing mechanism. This is where the money started moving. Once workers lost bargaining power, productivity gains turned directly into profit. As unions weakened, raises became optional. As jobs could be moved abroad, wages came under pressure. As automation took over tasks, workers were forced to compete with machines. As companies merged, employers' power over labor grew. And as shareholder value became the highest goal, wages stopped being a social foundation to protect and became a cost to be cut. The economy didn't lose its capacity to produce wealth. It became far more effective at redirecting that wealth upward. Companies themselves changed where their loyalty lay. Post-war corporations were no charities, of course, but many operated within a broader sense of obligation. Workers, communities, long-term investment, pensions, domestic production, and employment stability mattered more than they do today. By the 1980s and 90s, the corporation increasingly became a machine for maximizing share price. Even the language changed. Workers became labor costs, communities became markets, layoffs became restructuring, pension obligations became liabilities. And the shareholder, someone who might not even live near the factory, who knows nothing about the workers, who might hold the stock for less time than a carton of milk stays fresh, was declared the moral center of the company. The one question on everyone's mind was, so where did our money go? It went to profits, dividends, stock buybacks, executive stock payouts, mergers, acquisitions, cost-cutting, and financial engineering. A company can use its profits to raise wages, build new capacity, lower prices, strengthen pension funds, or buy back its own stock. Buybacks reduce the number of shares outstanding, which pushes up earnings per share and the share price. Shareholders benefit from this. So do executives whose pay is tied to stock performance. The company didn't stop making money, it just changed who that money was made for. At this point, the clearest proof that the gains didn't evaporate is visible in executive pay because the gains didn't vanish, they concentrated in certain hands. According to the Economic Policy Institute, in 1965 a CEO earned about 21 times as much as the average worker. By 2024, that ratio had risen to 281 times. From 1978 to 2024, top CEO pay rose by more than 1,000%, while average worker pay rose by only a small fraction of that. The problem isn't just that CEOs earn a lot, the real issue is the incentive structure itself. Modern executive pay is usually tied to stock awards, options, and market performance. If a CEO can raise the share price by cutting labor costs, closing factories, offshoring jobs, raising prices, buying back stock, or merging with competitors, that translates directly into personal wealth. The modern CEO is no longer paid just to run the company, but to enrich ownership. And in fact, a significant share of the money also went into assets: houses, stocks, retirement accounts, private companies, commercial real estate, intellectual property, platforms, data, patents, financial instruments. This is exactly where the generational divide becomes painfully visible. The post-war middle class usually bought assets with their wages. Today's middle class needs assets because wages alone are no longer enough. If you bought a home before housing prices exploded, that rise may have built your wealth. If you're trying to buy after prices already rose, that same rise is now a barrier standing in front of you. Same house, same economy, the only difference is which side of the door you end up on. Federal Reserve wealth distribution data shows just how concentrated ownership has become. The wealthiest 1% holds roughly a third of U.S. household wealth, while the bottom 50% holds only a small share. Asset booms don't enrich society evenly, they enrich those who already own the assets. Debt was the only bridge that filled the gap. As wages fell behind and asset prices rose, households had to close the difference somehow. Student loans replaced affordable education. Mortgages grew longer and larger because housing outpaced income. Credit cards covered emergencies. Auto loans stretched out. Medical bills turned into financial traps. By now, pay later schemes turned even small purchases into miniature debt structures. Debt became the bridge between stagnant wages and rising costs. But debt is a burden only for the borrower. For the lender, it's income. Every interest payment is someone else's cash flow. When wages can't cover housing, education, healthcare, or emergencies, people borrow, and the moment they do, future income they haven't even earned yet is already pledged away. The old promise was that work would make you feel secure. The new arrangement usually just says work will make you qualify for credit. Those are not the same thing. Why do earlier generations always seem more comfortable and luckier? That doesn't mean every household in 1965 was wealthy or that no one struggled. Poverty was real. Discrimination was real. Women were kept financially dependent by design. Black families were systematically denied housing wealth through policy and practice. But for the broad segment of workers and the middle class who were included, the path from labor to security was far more direct. A single stable income could do more. Housing was less detached from wages. College was less debt-driven. Pensions were more common. Today, people are told the economy is strong because GDP is growing, unemployment looks low, and markets are rising. But ordinary people don't live inside GDP, they live inside rent, groceries, insurance, childcare, healthcare, student loans, mortgage rates, car payments, job security, and whether or not they can actually save something tangible. An economy that's strong for asset owners can feel weak for someone living paycheck to paycheck. But if AI raises productivity, the question isn't whether the economy will produce more, it probably will. The real question is who captures that gain. If companies use AI to cut labor costs, expand profit margins, and reward shareholders, productivity will rise without broad-based security. This connects to the article's central idea. Wages aren't determined by productivity alone. They're determined by power. Bargaining power, political power, ownership power, institutional power, the power to unionize, to outsource, to automate, to regulate, to deregulate, to tax, to lobby, to merge, to buy back stock, to set interest rates, to enforce contracts, and to decide who gets bailed out when things break. Wages aren't just an economic outcome, they're a settlement of power. So the conclusion? The money never disappeared, it just changed direction. If wages are falling behind, where did the money go? It went to corporate profits, executive pay, asset prices, housing, debt payments, stock buybacks, shareholder returns, and into the portfolios of people who already owned the right things before prices rose. It went to those who collect claims rather than those who sell their time. But the deeper answer is much simpler. The money went wherever power allowed it to go. Earlier generations didn't have some magically better relationship with money. Many of them lived in an economy where the path from ordinary work to security was clearer. Today, that path has been narrowed, priced, financialized, and sold back to people as personal responsibility. You're told to budget harder, invest smarter, work longer, borrow carefully, keep learning new skills somehow to outrun an economy where the gains of growth are captured by others before they ever reach your pocket. Financial freedom begins with seeing this clearly. Knowledge alone doesn't fix the system, but confusion protects it. If you think your struggle is purely personal failure, you'll blame yourself. If you understand the structure, you make better decisions, ask sharper questions, and stop mistaking motion for progress. The money didn't disappear. It moved upward, outward, and into ownership. And history shows that when workers create more wealth but receive a smaller share of it, the problem isn't productivity, the problem is power. If this gave you a new perspective, don't forget to subscribe. See you in the next video.